Thanks for the organizers to offer me here the opportunity to speak to you. Also big thank to the previous speaker, to David. I'm grateful if Swiss Re Market Intelligence is used for such a presentation. But for today, I will not speak about the reinsurance markets. I'm going to save my words on that one for next week when we're going to meet in Baden, because that's the occasion where those talks shall belong to. My speech today will be more about the insurance gap we have. And we've seen a couple of slides this way. Sorry. Anyhow, we've seen a couple of presentations this morning already talking about the gap between the economic loss and the insurance loss. And I will not add any further data to that. I mean, what we can conclude from the events until 2016 is that probably 70% of the economic losses were not insured. Contrary to David, I will not dare to say anything about 2017. Main reason being simply I'm not allowed to, because our third quarter is going to be published during the first week of November. So you will understand that I will not be able to provide any further responses on that one. All I can say is that the ratios of economic loss or insured loss versus economic loss will probably be proven also by the events we've seen in 2017. So the essential question about insurance is actually, why is it so that many insurable risks are not insured? What is it what prevents customers from buying an insurance product? We already heard this morning a couple of additional reasons. So one reason I could add to this slide here is obviously a lack of fines for not paying the insurance premium, which seems to be a feature also in the Romanian market. But to look at it from a more global perspective, and probably also that aspect is related to the first aspect I mentioned here. So what are the main reasons for underinsurance we observe globally? And clearly an important factor is affordability. The fact that the existing insurance products are simply too expensive for a larger part of the society to purchase the necessary protection. That's a given feature we basically can observe all over the world. And as mentioned in the beginning, I spent the last 2 years of my career in Asia. There, this is very much a feature, and not just in Southeast Asia, where you would assume that income levels are low, and that's the reason. Also, a market like Japan shows lack of affordability as a feature why insurance against earthquake is not purchased. The other aspect, of course, is the question of, is it insurable? Is it insurable risk? And traditional insurance covers obviously do have certain exclusions. A few mentioned here. The location of the risk can be an issue, a reason why a certain risk is not insurable. The quality of a risk, or also the type of a risk. The other thing is policy restrictions. When you look into your own insurance products, which you hopefully have all purchased, and look into the wording, quite a lengthy part of my original policy, at least in the German market, contains exclusions. So when I read through it, I actually wonder what is actually covered. And I think that's a feature which we also see. There is clearly also an element of buying behavior. Customers purchase insurance for certain perils simply because they are aware of their exposure, they feel that this is a threat to them, but they are not buying it for others. Traditional insurance products, at least in most markets, and my home territory, Germany, is probably a perfect example for that, are overly complicated. I work now in the reinsurance business for more than 20 years. If I read my original policy wording, I still wonder what is covered, what not. So the complexity of the wordings. And thirdly, of course, also an unawareness of risk. This is related to how recently have events taken place, how much of a society has been affected by a certain risk. Undervaluation is clearly also something. Undervalued in terms of the property affected. And at least in certain parts of the world, it's also a lack of trust into insurers. I mean, when I meet friends privately and they ask me what I'm doing and I'm saying I'm working in reinsurance, and always the first comment is, I recently had a claim and it was not paid, right? So there is this society view on the insurance and a lack of trust. So parametric products, before I come into what that actually means, where could parametric come into the picture? Parametric has advantages on the affordability because we can scale down an insurance product to a specific peril and also to a partial coverage in contrary to the traditional indemnity-based. We can probably even insure risks which are otherwise on a traditional basis not insurable. We hopefully have less restrictions, and depending how we can basically measure the peril and measure the threat, we can increase the trust in the insurance industry because the product will be paid out quicker. What we can't change really with that is the buying behavior. I mean, that's something where you as the representative of insurance industries need to put focus on, and we can't do much about undervaluation either. So what is a parametric insurance? The difference between a traditional insurance product, which is indemnity-based, I have a certain defined indemnity, and as long as a physical loss takes place at my insured location in accordance with the definition of the indemnity, I receive a compensation. Whilst on a parametric product, it's not the indemnity as such, it's rather a physical measure which gives evidence that there will be an indemnity at the insured location. That's fundamentally the difference. So what is it, how do you structure such a parametric insurance product? I mean, the first thing, obviously, you need a peril. So you need a nat cat event as such. And that nat cat event can be measured in a reliable way in terms of its severity. So talking about earthquake, obviously the natural consideration there is the magnitude of an earthquake, or in terms of wind, it's the peak wind speeds or the gust wind of a hurricane, which is usable for that. You might implement a neutral independent third party then to determine the severity of the event. I mean, I followed with great interest the speech before the break from the representative of the National Institute for Earth Physics. So I think the data they have, the granularity they have with the measurement stations all around the country probably offers a sufficient level of granularity also in the Romanian market to think about a parametric earthquake insurance product. Because quite often, data is the essential feature about it. You might need then a calculation agent, basically transferring the physical event into a certain compensation factor, and then you have the traditional relation between the insured and the insurer, a payout to the insured as a function of the severity of the covered nat cat event. So that's in a very simplified way the concept of a parametric product. So where are the differences between what we currently know as insurance, here called the so-called traditional insurance, and the parametric insurance? First, of course, it's the payout trigger. I mean, on a traditional product, it's an occurrence of an insured loss in accordance with the policy definitions. Whilst on a parametric product, it's a physical parameter threshold which is defined, and once this parameter is exceeded, the insurance product will provide coverage and will pay out. So, for example, with earthquake, it's the magnitude of the earthquake measured at the next measurement station to the insured location. The payout amount. I mean, a traditional insurance concept normally has a sum insured, so it's a loss amount, and that's calculated after limits and deductibles. Parametric products simply have a predefined amount which is paid out. It doesn't really, ultimately, it doesn't even matter if the indemnity loss at the insured location is actually of the same amount as this predefined amount which is stated in the policy, because the amount is paid out because the parametric trigger has been exceeded. That's a fundamental difference to any traditional insurance concept. The use of the payout, I mean, if you have a property policy, then obviously the insurance payments you receive are intended to cover the indemnity, the repair costs, the installations and all that, whilst with a parametric product, it's at the customer's discretion what he's going to do with this amount of money. Is he going to invest that in order to repair his house or his premises, or is it in order to take care of immediate inconvenience costs related to the earthquake event? I mean, what you often see is that, for example, food prices increase after an earthquake event in certain parts. So simply take care of my increased costs for daily consumption. That's completely in the customer's hand to decide where I want to spend the amount of money I get. The payment speed, as you can imagine, I mean, on an indemnity product, you really need to do a loss adjustment, right? You need to, in most cases, you need to send a loss adjuster there to calculate the actual indemnity, and on that basis, you then receive an insurance compensation. On a parametric product, there is no need for loss adjustment because it's the parametric trigger which is exceeded, and it's the defined amount in the policy, and those are the two factors. So I can do payments very quickly on this type of product. I mean, experience with products in place shows us that basically after 2 weeks, for example in Japan, where we have quite a large portion of parametric earthquake insurance, most of the compensations have already been paid out within 2 weeks after the event. So loss adjustment, yes, of course, on traditional, no on parametric. Transparency. I mean, the loss settlement with an insurance policy with its conditions is a relatively complex feature to explain it to someone who is not dealing with such types of topics on a daily basis. The parametric one, I mean, if you think about the magnitude, I mean, everyone obviously will follow news. So if an earthquake exceeding 6 or 7 on the scale has reached my home ground, then I have cover, and that's pretty easy for everyone to follow. Basis risk, meaning basically the difference between what is actually paid out and what is the indemnity. It's obviously complete with a traditional product because you only get compensation for the damage you have. On a parametric basis, you have a mismatch, a potential mismatch, by the way, in both directions. You might have a significant indemnity and don't get a payment because the magnitude of the event has not been big enough, or vice versa. Scope, obviously traditional insurance products deal with insurable risks. Parametric products could go further, though when I think about the protection gap we have in place in most parts of the world currently, I think it's probably sufficient if we think first how we can transfer insurable risks into a parametric product before we think about the uninsurable elements. Budget is obviously, in both cases, it's a question of the structure. The interesting feature with a parametric product is you can probably customize it even further, and then you can do that with an insurance product. Is it an established product in most parts of the world? No. The parametric product is a new feature to many markets in the world. So, in a nutshell, what is the value proposition of such a parametric product? It's fast. That's one of the key advantages, and I think that's also an important feature when you think about big natural catastrophes. People need to have access to cash quickly in order to limit the impact. It's flexible in the sense how I can use that sort of compensation. And depending how you structure it, how you define limits and the like, it's affordable. And an important feature also on the part of affordability is that obviously the claims administration costs related to a parametric product are much lower than they are with an indemnity type of insurance solution. So obviously this is something we are not only discussing here in Romania, we have numerous projects on the globe, and with this also a bit of experience how clients look at such products and where the obstacles of such products could be. A common fear, and this is obviously something which needs to be carefully addressed, is the reputational risk. Again, with a parametric product, you basically shift an element of basis risk to the customer, meaning that even though I have a significant indemnity, a significant loss at my premise, because of the fact that the overall magnitude of the earthquake did not exceed the trigger of my insurance product, I will not receive compensation, even though it could be a tragic event. And that's clearly something where, in most of the cases, data, measurability, granularity of available data is a key factor. The more you can do in terms of granularity, the less basis risk will be with the customer and the less reputational risk the product will have. The other fear is it something we can explain to customers? Will customers understand also the fact that they retain a certain element of basis risk? Can we make that transparent to the customer? That's something which needs to be thought through. What we often hear in numerous parts of the world is, yeah, that's a great idea, give us the product and we sell it. And my response to that is, this is not possible. I mean, product development, specifically parametric product development, is not a copy-paste exercise. You can't take an effective product from one market and shift it like for like into another market. We need local market intelligence, we need local market responsibility, we need a proper understanding how a product needs to be structured in order to meet the customer needs in a certain territory. This is knowledge where we as a reinsurer obviously can only rely on you, the representatives of the insurance companies, the representatives of the market. Regulatory approvals can be a hurdle for that type of product, no doubt, because the question is this still insurance in the sense of indemnity, or is it rather a type of a derivative product structure which would lead to different accounting regulations? So that's a key feature of any parametric product innovation in any given territory of the world, is having a proper in-depth discussion with the regulator how this product needs to be structured in order to meet the local requirements in terms of an insurance product. And of course, speed of payment is a concern, though experience from products in place tells us it is quicker than traditional indemnity insurance products. But sure, specifically when you work in regions where financial systems are not highly developed, is getting the money to the poorer clients can be an operative hurdle. This is, for example, something we discuss in fair detail when we talk about such products in regions like Africa. How can we secure that the farmers will receive a payment in case of a parametric insurance loss? So sure, I mean, one thing, and that's why I'm here, is to share a bit of success stories, so what has worked, what we have seen, and of course we still will need a couple of events to show the proof of these concepts. We already have a bit of experience with it with earthquake in Japan, where we have events where parametric insurance products have been triggered, and it has worked, but it's clearly something where we have not a global expertise or experience at this point in time. So what are the areas where we see options for parametric insurance products? Public sector, money lenders, large corporates, SMEs, individuals. Those are the categories where we see most of the activity. Where does parametric insurance come in terms of the disaster recovery? It's primarily a feature for the period of resuming operations. Long-term reconstruction is probably something which needs to be in the field of traditional insurance, but providing ad hoc cash to affected people after the quake or after an event in the immediate phase after the emergency measures have been taken place, that's the area where parametric products normally play and where they play well. So what we do, for example, is in a couple of regions in the world, Turkey, Japan, New Zealand, California are mentioned here. When you look into the delta between economic loss and insured loss, quite often a substantial amount of it is related to business interruption. And the insurance penetration in business interruption, specifically when you look into small and medium-sized enterprises globally, is extremely low. Because the traditional product does not really give a sufficient response to the insurance need of a small shop, right? They need, if there has been a quake, if they are affected, they need quick cash. So BI related with a parametric trigger, with a fast payout, can be a partial solution to mitigate this gap between economic and insured loss. Loss cover for homeowners is something which we, for example, do in Turkey, where we basically provide a supplemental loss cover for homeowners. So after the Nat Cat event, a lump sum is paid out to the policyholder, and it's in conjunction with their traditional insurance products. Market risk for the tourism sector is something we do on a parametric basis. I mean, one example is in South America. I mean, Peru, the major destination for people traveling to Peru is to go to the Machu Picchu, the famous temple installation there. And there you have a couple of perils which can prevent people from simply getting there. So offering a parametric product based on wind speed or flood related to tour operators for that is something where we see parametric products to come in. It's small shops, so they cannot really afford a fully fledged product here either. Microinsurance solutions, Guatemala, Haiti, Africa is here mentioned. These are really very small scale type of products where we simply offer a small amount of money based on a parametric trigger to make sure that a larger part of the society has a sort of a basic coverage. The key factor about micro-insurance or microfinance products is the distribution. That's the thing where one needs to look into what is the most suitable distribution factor in a certain country. Public entities, obviously also states, buy protection for their governmental premises based on parametric products. In many countries, governmental assets are not insured. So they use the parametric market as a sort of a additional feature to that. Also in view of a reduced level of transparency about the insured premises which they have to provide. I will skip the technical aspect here. I mean, as a conclusion, parametric insurance can be a way how to manage the gap between the economic loss and the insured loss. I think what we have seen this morning in terms of the granularity of data available to earthquake exposure here in Romania gives evidence that we could probably structure products with a fair limitation of the basis risk. To be very clear, our value proposition as a reinsurer here is primarily modeling and structuring the product. We need to rely on your expertise to understand the specific client need, to also understand what is the fundamental obstacle in the customer's behavior, why current insurance solutions are not taken up. And thirdly, and most importantly about parametric products, what is the best way of distribution of such a product? Because the more and the broader you can reach out with such a product, the lower you can basically put the pricing in place. Thank you very much for your time.